Let's get started on Chapter 2, Building Blocks of Managerial Accounting. Now, I want to remind you that you don't have to watch this video. You can choose to read the textbook or download the PowerPoint from D2L Brightspace and read it on your own. One of those things have to be done before the class because I will not be covering this content in the class. Instead, we're going to focus on problem solving in class. So remember, this has to be done before the class starts. Let's get started. There are a total of 8 learning objectives for this chapter. It is quite a bit. We are learning a lot in this chapter, and much of it you are expected to know for the midterm and the final exam. So keep that in mind. There's the remainder of the learning objectives, and we're going to go through them individually. Let's start with learning objective 1. Distinguish among service, merchandising, and manufacturing companies. The 3 types of businesses are service companies, merchandising companies, and manufacturing companies. And so let's just look at a few examples. So service companies, they provide services. So we're talking advertising, banks, law firms, insurance companies. It's really the largest sector in Canada, and they are providing intangible services. We can also think about things like healthcare. It's a service. Or consulting. That's a service too. There's no inventory to sell to clients. Keep in mind, for a lot of service companies, salaries and benefits make up a huge amount of their total costs, sometimes as much as 70%. Next, we have merchandising companies. These are things like eBay and Walmart. Wholesalers are included in merchandising companies also. They resell tangible products, which they purchase from manufacturers or distributors. Keep in mind, retailers sell to the customer, the end users. Wholesalers buy in bulk, and then they sell to the smaller retailers who then sell to the consumers. Again, a few other examples of merchandising companies are like Rona. Trying to think of a few more. Amazon is a good example. They have one inventory account called merchandise inventory. And they have an inventory account because they're buying from the manufacturers or the wholesalers, and then they're turning around and selling it to the public. Finally, we have manufacturing companies. So these are things like McCain Foods, Bombardier Inc., Rocky Mountain Bicycles. In a manufacturing organization, they use labor and other things such as raw materials and the factory and a whole bunch of equipment, and they convert a raw material into a finished good. So Bombardier converts the raw materials with their labor in a factory and makes an airplane. They sell products to wholesalers or direct to retailers, or they might even sell direct to customers. There are 3 inventory accounts that manufacturing companies have: raw materials inventory, work in process inventory, and finished goods inventory. So let's just look at those right now. First, we have raw material inventory. And this is the inventory that's not yet being used in manufacturing, but it will be used in manufacturing of products. And it could be anything like glass, tires, fabric, whatever is necessary to create the finished good. Those are the raw materials. It also includes things that might be used in the factory, like lubricants for the conveyor belts or janitorial supplies. That's raw materials inventory. Next, we have work in progress inventory, which is also called work in process inventory. These are the goods that are partway through the manufacturing process, but they haven't as yet been completed. And finally, we have finished goods inventory, and these are the goods that have completed the manufacturing process, but they haven't as yet been sold. Let's do a quick check of your understanding. Distinguish among service, merchandising, and manufacturing companies. H&R Block, an income tax preparation service, is what type of company? Well, this is really simple because it actually says the word service in the question. So we know this is a service company. Among other things, General Mills makes breakfast cereal. Which type of company is General Mills? If they're making something, then they are a manufacturer. What type of company typically produces its own inventory? If they're producing their own inventory, that's production, that's a manufacturer. Before these materials are used to manufacture its cars, Honda classifies steel, glass, and plastic as, well, we know these are the things that will go into the manufacturing process, so this is raw materials inventory. Walmart classifies its clothing held for sale as, well, the clothing is finished. It's already completed. There's no more manufacturing, so we know this is finished goods inventory. How would Honda classify its partially completed vehicles? Well, it's partially completed, so we know it's work in process. Remember, you need to be able to identify the different businesses and what those businesses do. Objective 2. Describe the value chain and its elements. So a value chain is everything that a company does in order to add value to its products or services. And keep in mind that all of these things that add value, they're going to consume funds, resources, money. So to price any kind of product or service, organizations really have to take into account all the costs that are incurred in the value chain. So here's the value chain. Let's go through each item. Research and development. This is either a new product or an improvement to an existing product or service. It also includes a new or improved production process. So for instance, they used to do production in a particular order, and now they change that order because they've realized that they can improve production by changing the order of the production process itself. So all of this is research and development. Next, we have design. This is where we take a product or a service and we engineer the product or we decide on the process for the service. Keep in mind, this is also designing all the processes to produce an end product. Next, we have production. That's for manufacturers. Or we have purchases, which is for merchandisers. This is all the resources used to actually produce a good or a service or to buy the finished goods needed to resell them for a merchandiser. We have marketing, which is basically advertising, promoting our products and services. We have distribution, which is delivering the actual product or service to the customer. And then we have customer service, which is all the support we provide to our customers after the product or service has been sold. So keep in mind that value chain, understanding it is very important. Let's check your understanding. Describe the value chain and its elements. The promotion of products and services is known as, well, if we're promoting it, we know we're marketing. Depreciation on a factory would be classified as a cost in which part of the value chain? Well, it's depreciation and it's on the factory, so we know this must be production. A technical support hotline for customers would be considered which part of the value chain? They said the word customer, so this is customer service. Moving on to objective 3, distinguish between direct and indirect costs. In order to do that, we have to understand a cost object. And a cost object is anything where we have to determine what it costs. And a cost object is anything that actually accumulates costs. This cost object actually causes costs to happen. So anything that causes costs to happen can be a cost object. For instance, a cost object could be a table. Manufacturing that table or desk, that is a cost object. Why? Because it causes costs to happen. However, a cost object could also be the factory. Running a factory causes costs to happen. Either of these things, the actual product that the factory makes or the factory itself, can be a cost object. And you have to understand, what is the cost object? Why? Because it feeds into the concept of direct and indirect costs. A direct cost is one that can be physically and directly traced to the cost object. For instance, the wood that's used to make a desk is a direct cost. It can be physically and directly traced to the desk. An indirect cost happens because we're manufacturing something, but the cost cannot be easily traced to the cost object. Instead, we have to estimate the indirect cost, and then we allocate them to the cost object. So an example would be, we're making a wooden desk and I'm using glue in order to glue the pieces of wood together. It would be impossible for me to determine how much glue I'm using every single time. That's an indirect cost. I cannot easily trace it to the cost object, which in this case would be the desk. Instead, we're going to estimate the cost of the glue, and then we're just going to allocate it to the desk. I'm not going to, count how many drops of glue I actually use. I'm just going to say, for every single desk, I estimate that I use a 1/4 cup of glue. And regardless of how much I use, I'm going to allocate the cost of a 1/4 cup of glue to the desk. Let's go through a few more examples using the office furniture manufacturing company. They want to figure out what the cost of one desk is. The direct costs would be things such as wood and direct labor. The people in the factory that are actually involved in manufacturing, making that desk. The indirect costs would be any and all other costs that we incur in order to manufacture the desk. So things like oil for the machine, indirect labor, like the supervisor's salary, right? The supervisor in the factory is supervising the creation of all these desks, but that supervisor is not working on every single desk. They're just overseeing the whole manufacturing process. And everything else about the factory, the rent for the equipment, or the rent for the factory floor, or the utilities, or that glue, or the staples, those are all indirect costs, and they have to be allocated to the cost of the desk. Keep in mind, when we assign costs to the cost object, we can either trace them, direct costs, so this is the direct labor and direct materials, and we know the amount of all of the direct costs because they can be directly traced to the cost object. However, we've got to allocate the indirect cost to the cost object, and so we're just assigning it, and it's not really perfect. It's not precise. Remember I said that the cost object can be anything that causes costs to happen. In this case, we have the cost object as either one desk or the whole factory. Either can be the cost object. So why does it matter what the cost object is? Because it changes cost from being direct to indirect. For example, the cost of the factory, such as equipment depreciation, property taxes, hydro costs, those are all indirect costs. Indirect costs when we're making one airplane. So in this case, one airplane is the cost object. But if I change the cost object to being the factory that's making all of the planes, then the depreciation, property taxes, and utilities become direct costs. Why? Because they can be traced directly to the whole factory. I don't have any problems. I'm not allocating anything. I know exactly how much the depreciation is for the whole factory. I know exactly how much the property taxes are for the whole factory and the utilities. So this is a direct cost to the factory when the factory is the cost object, but it's an indirect cost to the airplane if I'm costing only one airplane. So when you're asked a question about direct and indirect costs, be sure you know what the cost object is in the question before you decide what the right answer is. Now let's do a quick check. Assume a grocery store manager wants to know the cost of running the produce department. So the produce department is the cost object. Which of the following would be considered direct costs of the produce department? Wages of checkout clerks has nothing to do with the produce department, so that is not a direct cost. wages for workers in the produce department. In that case, it's direct labor. That is a direct cost. Depreciation on refrigerated produce display cases. Well, you'd think that wasn't direct, but it is direct. Why? Because that's depreciation only for the refrigerated produce display cases, which are in the produce department. So it's definitely direct to the produce department itself. Cost of weekly advertisements in the local paper has nothing to do directly with the produce department, so that is not a direct cost. Cost of bananas, lettuce, and other produce, that is definitely a direct cost to the department. Baggies and twist ties available for shoppers in the produce department. It's only being used in the produce department. It's a direct cost. Monthly lease payment for grocery store or retail location. That might be indirect, but it's definitely not direct. Cost of scales hanging in the produce department. Those scales are only used for produce. It's a direct cost. So you can see these are the items that are direct to the produce department. Now, what if I changed the cost object to the whole grocery store? So now the grocery store is the cost object. In that case, if I'm looking at the direct costs of the grocery store, every single one of these costs would be a direct cost. Why? Because the grocery store is causing all those costs to happen. By changing the cost object, we also change what is direct and what is indirect. Moving on to Objective 4, identify the inventoriable product costs and period costs of merchandising and manufacturing firms. So what is a product cost and what is a period cost? A product cost is the cost of either producing a product for manufacturing or buying the product for a merchandiser. They're also called inventoriable because they're finished goods that are ready for sale, and all of these costs will be recorded in inventory, which is an asset on the balance sheet. A period cost is a cost which is not connected to manufacturing in a manufacturing environment or purchasing process for a merchandiser. These costs are expensed to the income statement as they are incurred. So remember, a period cost has nothing to do with either manufacturing for a manufacturer or nothing to do with the whole process of purchasing inventory for a merchandiser. If we look at the value chain, we can see that the only product cost, which is inventoriable, is the production or purchasing costs. Every single one of the other costs on the value chain are period costs, which are expensed immediately when they happen. So research and development, design, marketing, distribution, and customer service, they are all period costs. So you'll notice here we have a chart which shows inventoriable product costs for the different types of company. So service company, there aren't any product costs. Nothing is inventoriable because all you're doing is providing a service. Period costs are absolutely everything. Why? Because there's no product, so there's no inventory. For a merchandising company, inventoriable product costs are the cost of what you buy plus everything you incurred to get the product on the shelf. So freight in, customs, duties, everything you had to pay to get that product on the shelf, that's an inventoriable cost. Every other cost, except that inventoriable cost, are all going to be period costs. Salaries, depreciation, utilities, insurance, property taxes, advertising, freight out, all period costs. For a manufacturing company, we got direct materials, direct labor, manufacturing overhead. Those are all inventoriable. Everything else in the value chain is a period cost. R&D, freight out, all the expenses for headquarters, depreciation, utilities, insurance, property taxes, everything we do for head office, advertising, CEO's salary, these are all period costs. There are actually two definitions of product costs. The first definition is the total costs, and the total cost is not anything to do with generally accepted accounting principles, IFRS, or ASPE. It's used only internally. So the total cost is looking at all the value chain items that went into producing this product. And we look at all of that because we want to price everything appropriately so that we cover all the costs of producing the product, including things like R&D. That's why, for instance, drugs are so expensive, because the drug isn't just for producing that pill. It's for all the R&D that went into creating that pill in the first place. So that's a concept of a total cost, which includes everything in the value chain. Inventoriable product costs, those are used for external reporting, generally accepted accounting principles, IFRS or ASPE. That is one concept. And then we've got the concept of total cost. Remember, total cost is used when we're making decisions, but inventoriable product costs are used when we're actually reporting. Now, product costs in manufacturing include direct materials, direct labor, and manufacturing overhead, which are all the other costs of production. Let's go through them individually. Direct materials are all the raw materials that we can directly trace to the product. They'll be part of the finished goods, and we can actually physically trace them to the finished good. Direct labor are all the employees who are physically taking those raw materials and converting them into the finished good, like the table. And then manufacturing overhead is all the manufacturing costs other than direct materials and direct labor. So every indirect cost is manufacturing overhead. Now I want you to recall, with regards to the cost object, indirect costs are costs that are incurred because we're manufacturing something. If we weren't manufacturing something, we wouldn't incur these costs, but we cannot trace them physically to the finished good. So this is things like indirect material, the glue that I was talking about, indirect labor, the supervisor salary, and then all the manufacturing costs of the factory. So things like the depreciation on the factory equipment, the property taxes of the factory that we have to pay, the insurance that we have to pay for the factory, all the utilities that go into running the factory. All of these things can't be traced directly to the end product. So because the cost object is a product, a good, they are indirect and they have to be allocated. So let's do a quick check. Identify whether the following are period costs or product costs. If they're product costs, tell me if they're direct materials, direct labor, or manufacturing overhead. So we're going to denote period costs as PC and product costs as DM, direct materials, DL, direct labor, or MOH, manufacturing overhead. Remember, MOH are indirect costs that are incurred due to the manufacturing process. If it has nothing to do with manufacturing, then it's a period cost. So let's get started. Depreciation on automated production equipment. Part of production, it's MOH. Telephone bills related to customer service call center. Has nothing to do with manufacturing, it's a period cost. Wages and benefits paid to assembly line workers in the manufacturing plant. They're assembly line workers. They're working directly on the product itself, producing it, converting raw materials to the finished good. That is direct labor. Repairs and maintenance on factory equipment. It's part of the factory, but I can't trace it directly. MOH. Lease payments on administrative headquarters. This is nothing to do with production. This is a period cost. Salaries paid to quality control inspectors in the plant. Plant is the same as factory. Can't trace it directly to the product, but it is part of the manufacturing process. It's MOH. Property insurance. 40% of building is used for administration and 60% used for manufacturing. Well, in that case, I have to split the property insurance costs into two pools. 40% are period costs and 60% are manufacturing overhead. Standard packaging materials used to package individual units of product for sale. So this is part of the manufacturing process because we're finishing the manufacturing and packaging everything. This is a direct material. All right, what else do we need to know about manufacturing costs? We need to understand prime and conversion costs. Prime costs include direct materials and direct labor. They're considered prime because they're primary for converting raw materials into a finished good. Conversion costs include direct labor and manufacturing overhead. These costs are used to convert direct materials into a finished good. So that's why they're called conversion costs. Now, there's something important you have to note when you're doing calculations for prime costs and conversion costs. You cannot add prime costs plus conversion costs to get total costs. And that's because if you did, you would duplicate the direct labor and multiply it by 2. So never add these two amounts together to determine the total cost of a product, because it would duplicate direct labor. Let's move on to Objective 5. Prepare financial statements for service, merchandising, and manufacturing companies. Now, some of this is going to be a review because you already had this from Introductory Financial Accounting. We know that a service company has no inventory. A merchandiser has a merchandise inventory, and a manufacturer has raw materials, work in process, and finished goods inventory. Now, if we start by looking at the income statement, we can see that the income statement of a service company has no cost of goods sold. Why? Because they're not selling any goods. There's no cost of goods sold. There's just service revenue and then all the expenses that go along with service revenue, which in this case are 100% period costs. If we're looking at a merchandiser or manufacturing company, we can see that this is a multi-step. Over here we got a single step, and it's single step because there's no cost of goods sold. Over here, multi-step for merchandising and manufacturing because we've got a cost of goods sold. So we take sales revenue, subtract the returns and allowances, subtract the discounts, we get net sales, then we subtract the cost of goods sold and we get gross income, also called gross profit. Then we deduct all the period costs. In this case, we've got operating expenses for rent, salaries, and utilities. And once we deduct that, we get the net operating income. We've got other revenues and expenses, $8,000, and this is net income. Somewhere in here, we better have taxes, right? We know that net income is after taxes, over here net income, but we're just going to ignore that factor to begin with. Okay, so now the question becomes, how do we calculate cost of goods sold? We've got cost of goods sold right here. How do we calculate that? Well, calculating cost of goods sold for a merchandising company is pretty easy. You did it a lot in Introductory Financial Accounting. If we take the beginning inventory and we add in all of our purchases, it is equal to the goods available for sale. So all the beginning inventory plus all our purchases are available to sell to our customers. If we then deduct the ending inventory from the goods available for sale, because the ending inventory is what's left on the shelf at the end of the period, we know that that is equal to cost of goods sold, the cost of all the goods that we have sold to customers. Now notice something interesting. The goods available for sale are equal to the beginning inventory plus the purchases, but it is also equal to the ending inventory plus the cost of goods sold. We can see that when we go back here, because here we got the available for sale minus ending inventory. Well, if I want to, I can say cost of goods sold plus ending inventory is equal to the cost available for sale. And that's what we're seeing right here. Now, this is just a way of manipulating the equation to get the goods available for sale. Okay, remember for a merchandiser, once we've got the cost of goods sold, we can then put it into the income statement and calculate the gross income or gross profit. How do we calculate the cost of goods sold for a manufacturer? Well, this is more complex. Step 1 is to calculate the cost of the raw materials used in production. How do we do that? We take the beginning raw material inventory. We add in all the purchases. Now this is all the material we have available for the whole year to produce products. We then take the material available for use, subtract the ending raw material inventory, the stuff that's still sitting on the shelf at the end of the period, and that is equal to the cost of all the raw materials we used in the production process. Next, we have to calculate the cost of goods manufactured. This is the cost of all the goods that were finished during the period. How do we do that? We'll take the beginning work in process inventory. Remember, that's the unfinished goods that we were starting to produce but didn't finish at the beginning of the period. We're going to add in the raw materials that we used. We're going to add in the direct labor and the manufacturing overhead. And that's for the whole period. That is equal to the goods manufactured. Then, the goods manufactured minus the ending work in progress. So the items that are still sitting on the conveyor belt unfinished at the end of the period, and that is equal to the cost of all the goods, the finished goods that were manufactured during the period. Now, this appears to be pretty straightforward, but actually we have to create what's called a schedule of cost of goods manufactured in order to calculate these amounts. Notice what's on this schedule. We start with the beginning work in progress inventory, $2,000. We add in the direct materials used. Notice it's using our formula. Beginning raw materials inventory, $9,000. Add in the purchases, $27,000. This is the available for use raw materials, $36,000. Deduct the ending raw materials inventory, $22,000. So the direct materials used is $14,000. We know this formula because I just covered it in step 1. I'm now going to add in the direct labor, and I'm going to look at all the manufacturing overhead that went into production for this period. So I look at it and I see indirect materials, indirect labor, depreciation on the plant and equipment, plant utilities, insurance and property taxes, total manufacturing overhead, $12,000. Add those three things together, $14,000 plus $19,000 plus $12,000. That is equal to the total manufacturing costs incurred during the year, $45,000. Add that into the beginning work in progress, and we end up with total manufacturing costs to account for, $47,000. Deduct the ending work in progress inventory. Notice it says work in progress here and work in process down here. Doesn't make any difference. Both things are identical. So less the ending work in process inventory, $5,000, and this is the cost of goods manufactured. Now, I want to remind you, we know all these formulas because I went over them already. So we're just ending up at this cost of goods manufactured. Note that you need to be able to recreate this schedule with any information I give you on the exam. All right. Step 3 in calculating the cost of goods sold for a manufacturer is to actually calculate the cost of goods sold. So how do we do that? We start with the beginning finished goods inventory from the start of the period. Then we add in all the goods manufactured during the period. That's equal to the available for sale. We take the available for sale and we deduct the ending finished goods inventory, the stuff that's still sitting on the shelf unsold, and that is equal to everything we sold, the cost of goods sold. So keep in mind, that's what you have to do. Create this number in order to put it on the income statement for a manufacturing organization. All right, let's do a quick check to see if you understand everything we just went through. The flow of inventory costs in a manufacturing company is A, work in process, raw materials, finished goods. So is that the correct order that we put them in? B, finished goods, work in process, raw materials. C, work in process, finished goods, raw materials. Or D, raw materials, work in process, finished good. Guess what? It's D, raw materials come first, then work in process, and then finished goods. Which of the following is calculated last before operating income can be determined for a manufacturer? The cost of goods available for sale, the cost of goods manufactured, the cost of goods sold, or the cost of direct materials. So which is calculated last before operating income? And that is the cost of goods sold. We need to have that information in order to calculate operating income. The main difference in the balance sheet of manufacturing versus service businesses is in current assets, current liabilities, investments, or equity. Well, the main difference is in current assets because there's no inventory for a service business, and there are multiple inventory accounts, including raw material, work in process, and finished goods inventory in a manufacturing environment. Which of the following would be on the balance sheet of a service company? Factory equipment depreciation? No. Cost of goods manufactured? Absolutely not. Cost of goods sold? No. Accounts receivable? That would be on the balance sheet, yes. Active Apparel Company reports the following data for its first year of operation. Cost of goods manufactured, $500,000. Work in process inventory beginning, 0. Work in process inventory ending, $120,000. Direct materials used, $85,000. Manufacturing overhead, $100,000. Finished goods inventory ending, $72,000. What are the total manufacturing costs to account for at Active Apparel Company? Now, you need to know what the total manufacturing costs to account for actually are. Like, where is this line item? Well, in the schedule of cost of goods manufactured, you can see down here total manufacturing costs to account for. So this is all of the costs that were incurred during this period plus the beginning work in progress inventory. Okay, so that's what we need. That's the number we need. So now we have to see, do we have all this information so we can calculate it? So let's move on and see. Well, we don't have all that information. We have cost of goods manufactured, $500,000, and work in process inventory ending. We do have work in progress inventory beginning and direct materials, manufacturing overhead. We don't have direct labor. So we can't go through this calculation right here because we don't have this piece of information, direct labor. We don't know what it is. So we can't do the full calculation. What can we do? Well, we've got cost of goods manufactured and work in process inventory ending. Cost of goods manufactured, work in process inventory ending. We can work backwards to do the calculation of the total manufacturing costs to account for. So let's do that calculation. We've got X minus work in progress inventory ending is equal to cost of goods manufactured. I have the work in progress inventory ending, $120,000. I have the cost of goods manufactured, $500,000. I do the calculation and I discover that X, which is the total manufacturing cost to account for, is $620,000. And that is answer A. So notice sometimes the question is going to ask you to do something backward. What is the cost of goods sold at Active Apparel Company? $500,000, $428,000, $685,000, $548,000. I shouldn't really look at these things because I can't guess about this. I can go back to step number 3. Calculate the cost of goods sold. I need the beginning finished goods inventory plus the goods manufactured equals available for sale. Available for sale minus the ending finished goods inventory is equal to the cost of goods sold. So what do I have? I have the cost of goods manufactured and I have the finished goods inventory ending. Well, that's great. I have 2 numbers, but I don't have the beginning finished goods inventory. Don't I? Go back to the question. It's first year of operation. That means the beginning finished goods inventory was 0. So I can do my calculation. 0 plus 500,000 is equal to 500,000. 500,000 minus 72,000 is equal to 428,000, and 428,000 is B. All right, moving on to objective 6. Describe costs that are relevant and irrelevant to decision making. So what is a relevant cost? A relevant cost has to differ be different between alternatives, because costs that are the same, they won't influence the outcome or choice between alternatives. I'll give you an example. If a company is leasing manufacturing space for $10,000 a month, and they are trying to decide whether to make product A or product B in the space, the lease payments are not relevant because they have to be paid regardless of whether I produce product A or product B. So I shouldn't even think about them because they don't change between alternatives. What do I care about these lease payments? They don't matter. They're not relevant. So keep in mind, relevant costs differ between alternatives. When you're trying to decide between two alternatives, relevant costs matter because they are different. In addition, relevant costs have to be future costs, because if you've made a decision and spent money in the past, then it can't be changed today or tomorrow. So relevant costs have to be different between alternatives, and they have to be future costs, not something that happened in the past. Only costs which meet these two criteria are relevant for decision making. Irrelevant costs are costs that are made in the past. We call this sunk cost. We can't change anything. Or they're costs that are the same regardless of the alternative you choose. So if a cost does not meet the two criteria for a relevant cost, it immediately becomes an irrelevant cost. Now remember those two criteria. It's got to be different between the alternatives, and it's got to be a future cost, not a past sunk cost. Okay, we've got relevant and irrelevant. Anything else we need to know? Yes. Controllable costs. Controllable costs are costs that management can influence or change. So if they're doing, for instance, marketing by advertising a product, they can decide to advertise or not advertise. So that's a controllable cost. Then we have uncontrollable costs. These are costs that no matter what management does, they can't change them. So for instance, property taxes are given to a company by the government. The company cannot decide not to pay property taxes. If they're leasing or renting equipment, they can't decide to stop paying the rent. They have to pay the rent. So any kind of costs that are uncontrollable, and usually in the short term, because in the long term, we could decide to stop leasing this space. We're never going to be able to decide not to pay our property taxes, but in the short term, they're uncontrollable because to change them would be a long-term perspective. So that is a controllable cost. We can change it in the short term. Uncontrollable cost, we either can never change it or we can't change it in the short term. Objective 7, classify costs as fixed or variable and calculate total and average costs at different volumes. Now we're not going to do all of that. Some of that is going to be done in class when we're doing the problems, but I am going to cover some of this. So what is a fixed cost? A fixed cost is one that is the same in total over a wide range of activity levels. So whether I make one product or 400 products or 10,000 products, it's going to be the same. Activity levels are how much activity we actually do. A good example would be insurance costs on a truck. No matter how many kilometers you drive, it's going to be the same. If I drive 1,000 kilometers, 10,000 kilometers, or 0 kilometers, I'm still going to have to pay for the insurance on the truck. Variable costs in total change the more the activity changes. So if an activity goes up, the variable cost is going to go up. And if the activity goes down, the variable costs are going to go down. So total gasoline costs when we drive more kilometers goes up. If we drive 0 kilometers, it's going to go down to 0. So it's in proportion to the amount of activity. So variable costs in total go up as the activity goes up and down as the activity goes down. Now, in manufacturing costs, you can see direct materials, the more we produce, the more we use. The less we produce, the less we use. So it's a variable cost. Direct labor, The more we produce, the more we use. Now, we could have an argument about that, but let's just, for right now, just treat it as a variable cost. Manufacturing overhead, well, that's like property taxes and rent on the factory and depreciation on the equipment. Even if we don't use the equipment, it's still going to depreciate. So this is a mix of fixed and variable costs. Now, why is it a mix of fixed and variable? Fixed, we've got it, depreciation, property taxes. Variable, well, the more we run the factory, the more electricity we use. Electricity is a manufacturing overhead because it's indirect to the product. So it is a variable cost. So it's a mix. So inventoriable costs, we got variable, variable, fixed and variable. This is a mix of fixed and variable. Okay, let's check our understanding. Which of the following describes the way in which variable costs per unit behave? They will decrease as production increases. They will increase as production decreases. They will remain the same as production levels change. They will decrease as production decreases. Now, what's really important is to see that it says variable costs per unit behave. And variable costs per unit will remain the same no matter what happens to the production level. Whoa! But I just said that variable costs change in proportion. Did I? Let's go back. I said variable costs change in total. So, if I am using gas to drive kilometers, the more I drive, the greater the total cost of my gas. However, I paid $1.34 for every liter of gas that I put in there. So the per kilometer use of gas is going to be the same. As long as I continue paying the same amount for each liter of gas, the per unit, per kilometer cost of that gas is going to stay the same. It's not like the more kilometers I drive, the greater the cost per kilometer for the gas. No. I'm using the same amount of gas no matter how many kilometers I drive per kilometer. Per unit variable costs stay the same. I'm still going to pay $1.34 per liter for my gas, no matter how many kilometers I drive. Well, as long as it doesn't change at the pump. But you get what I'm saying. Be careful about this. Read questions carefully. Are they asking about variable costs in total or variable costs per unit? Which of the following describes the way in which total variable costs behave? This is total variable costs. They remain the same as production levels change. They will decrease as production decreases. They will decrease as production increases. They will increase as production decreases. Total variable costs, they will decrease as production decreases and increase as production increases. That's because they're total variable costs. The more kilometers I drive, the greater the total amount of gas I'll use. Which of the following describes the way in which total fixed costs behave? They will remain the same as production levels change. They will decrease as production decreases. They will decrease as production increases. They will increase as production decreases. Well, this is total fixed costs. They will remain the same as production levels change. Which of the following describes the way fixed costs per unit behave? They will remain the same as production levels change. They will decrease as production decreases. They will increase as production increases. They will increase as production decreases. This is fixed cost per unit. They will increase as production decreases. Let me give you an example to make this clear about fixed costs per unit. Say that total fixed costs are $500,000. Production in units is 100,000 units. Fixed cost per unit is equal to 500,000 divided by 100,000 units is equal to $5 per unit. Now, assume that production is reduced to 50,000 units, but total fixed costs stay the same at $500,000. Now fixed costs per unit are equal to $500,000 divided by 50,000 units. That's equal to $10 per unit. So, as production decreases, fixed costs per unit increase. The opposite is also true. If production increases, the fixed cost per unit will decrease. We're on to the last learning objective. 8. Analyze revenue, costs, and inventory data using data analytical tools. Well, in order to do that, we are going to actually use Excel. So let me flip over to Excel. So what we want to do when we're analyzing revenue, costs, and inventory data using data analytical tools, we want to summarize information from a large data set. In order to do that, we'd like to sort the data by specific criteria. We might do it by the date or by the location. We might do it by the customer number. Whatever we're doing, we're trying to filter the data in order to look at a specific subset of the data. And we're going to utilize Excel tables to analyze this data. How do we do that? We're going to start with the data set. So here's my data set. I've got all this data right here. Okay? To convert the data set into an Excel table, we need to click on any cell within the data set. So I could click anywhere here. It doesn't make any difference. As long as I'm in the data set, I just have to click on one of the cells. And then I'm going to go up here, and you see up here, there's an Insert tab. So I'm going to click Insert. And then I'm going to click Table. So create a table to organize and analyze related data. Tables make it easy to sort, filter, and format data within a sheet. So here we go. I could do Tell Me More, by the way, but I'm not going to. I'm going to click on here. Now notice it's already deciding what the range is. Could I determine the range myself? Yes, I could. I can left click on the date and hold the left click down. Pull it across, pull it down. There we go. And there it is. I could have created it myself. Does my table have headers? Yes, it does. I'm going to click OK. There we go. So now notice I've got all these little filters right here. So I click here and I say, I don't want to select all. I want to look at everything for Toronto only. So what are all my Toronto customers? And there we go. I've got customer 132, 216, 183, and 330. I want to look at all of them again. I can do that. I want to look at only specific dates. So I'm going to click here and I want only January 7th. So I say, okay, there's 2 sales from January 7th. I go back over here and I want everything for 2025. I'm going to click OK. This is one of the ways that I can look at the information in order to better understand it, to analyze large amounts of data. That's it for Chapter 2, Building Blocks of Managerial Accounting. Remember, we're going to cover questions in class that will expand on some of the concepts that I've covered in this lecture.